Hi, it is May 3rd, 2023, and we're going to be talking a little bit today about consensus, revenue growth, and margins. But I'm going to break it down very simply since I've heard from you, hey, I'm not in the financial industry, help me out. So let's just start with consensus. So consensus right now is for recovery and profits. So what does that mean? It means that people are thinking, so analysts who look at companies are saying, hey, there's going to be more profits later on. And they're saying it's driven by higher profit margins, so making more money per dollar. There's a company called Absolute Strategy Research, I call them ASR. It's out with a really good piece today, notes that the S&P's net profit margin, so the margins that per revenues, have declined from 12.9% in the first quarter of 2021 to 10.8%, roughly speaking, this quarter. But analysts are forecasting that to go up. It's going to improve back to 11.4% in the next year, so the first quarter of 2024. And if you think about it, just like the banks who didn't seem to use Excel that well to figure out that their bonds would lose a lot of value when short-term rates went up, it seems that analysts might not be incorporating the results of lower pricing power. So what does that mean when you have pricing power? Is you can keep raising prices and people will pay for your goods. But at some point, most people don't have ultimate pricing power because demand, so what people will buy, will go down. It's just too much for people. So you know how companies jacked up prices over the last few years. You know, just visit a Starbucks or a Restoration Hardware or buy some ice cream. You can see it right away. But when companies can't keep raising prices, instead lose that pricing power, it affects companies' bottom lines. So just look at Tesla slashing car prices continually. We keep hearing about that, and they've got a lot of inventory. So with labor costs being high and sticky, guess what happens when revenues decline and costs remain high? So I'm going to give you my hand puppet here today is, I guess I'm going to do it from your stand. What happens when revenues decline and costs remain high? Well, if this is margins, it means it's less margin. So the hand puppet mouth is closing in on you here. And the growth of revenues in the US is decelerating. So remember, ASR puts it at a positive 9.9%, but it compares to costs growing at 11.9%. So coming back to this hand puppet, if your revenues are going up by this much, but then costs are going up by more, again, hand puppet time, guess what happens to the profit margins? They're going down. So even if companies cut costs, so we're hearing a lot about that, and you probably hear about it, like all the layoffs that we're reading about, hearing about in the media. Let's go back to the hand puppet. Guess what happens when growth overall, when people lose their jobs? People lose their jobs, that's right, they spend less. But if you've got costs still pretty high, what happens? Margin goes down. So when you're destroying demand, even if before costs were going up and they're not going up as much, when revenue is really coming down, again, hand puppet tells you it's closing in on you here. Not so good for profits and profit margins. So we want to tell you consensus, when they're saying, gosh, things are going to get a lot better, we're saying, hey, prices have been way too high. People are losing their jobs. The economy is slowing relative to costs going up so much more. Be careful when you are buying into a security. Look at the fundamentals and understand what are people betting on, because if it doesn't align with things maybe not being as rosy as what people expect, there's more asymmetry to the downside. So it means your odds are not as good as buying something where low expectations and things can only get better. That's the tip for today, and we'll see you back tomorrow.